Ladies and gentlemen, I know it's only Monday, but go pour yourself a drink on the rocks, make it a double if you need, grab a cigar, and let's talk about the day that was. Firstly, happy Easter to all my Christian followers, and what a crazy day it has been. Stocks continue their absolute crazy volatility every time Donald Trump tweets. Trump wants Jerome Powell out. He wants China to cave. Trade talks seem to be stalling, and that is why we're selling. But where do we go from here? That is the question we're going to ask and answer today. We're going to be looking at the economy, the labor market, and earnings, and a whole bunch of other indicators to determine where we go next. So do we go higher, or is this the end? We've got a lot to talk about. Let's roll the tape.
Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it.
This is the daily heat map of the S&P 500, and US stocks tanked on Monday as President Trump hurled more social media insults towards Federal Reserve Chair Jerome Powell, sparking concerns of Fed independence at a time when markets are still reacting to the president's whip-soaring tariff policy. And as a result, stocks sold off in a very significant way. Very, very ugly day today. Just a complete liquidation. Even your quintessential defensive sectors were red. There were a couple of green. That's about it, but far and few between. And in the tech space, it was literally only Netflix up 1.38% today. And then we saw some red here in Capital One and Discover Financial based on some news of a merger that recently got approved. That was really it. Every single sector was red here today. And look, the best performing sector was staples, falling 1.5%. Gold was the only hedge, up 3.22%. Absolute strength. And that's telling you everything you need to know. Tariff and policy uncertainty is driving safe haven demand, stuff like gold, and not even treasuries, just gold itself and other commodities like silver. The selling was led by tech and the discretionary space. Both were down in excess of 3%. The SPY falling just shy of 3%. And it was a dumpster fire everywhere. Small caps, mid caps, large caps, value, core, and growth. And this really stemmed off what Donald Trump posted here on Truth. Donald Trump called for lower rate cuts. Now, he warned of a slowing economy unless Jerome Powell actually cut rates. And the market just didn't really like this at all. In fact, in the pre-market, we were looking fairly resilient. Then Donald Trump came out and started speaking, and then the market decided to. And then what also didn't help sentiment today was that China came out and they vowed to punish countries that agreed to Trump's trade deals. So pretty much the ongoing trade war is happening with China and the US, tit for tat. It looks like we got a trade war on our hands, and China is also seeking to strengthen its own ties with other nations that have been hit by Trump's tariff policy. And the risk here is that if a lot of these European countries, a lot of these South American countries start to side with China, that isn't a good look for the United States. And adding on to this, the reason why tech stocks sold off is because Chinese tech giant Huawei is set to begin shipping advanced AI chips as soon as next month, after Trump's new export rules effectively banned the company from selling its H20 chips in China. Huawei's new 910C chips are reportedly competitive with NVIDIA's H100 AI chips, which are 2 generations behind its Blackwell chips. The H100 graphics cards were banned from export to China by the US government in 2022. And long story short, because of all of the volatility we're seeing, China has ramped up its own supply of chips, and this may impact NVIDIA, especially if someone like Huawei does get a competitive chip. Not necessarily now, but looking 2, 3, 4, 5, 10 years down the line, and this can significantly impact NVIDIA's moat. And as a result, NVIDIA led the selling in the tech space, down 5.68%. Very, very ugly day. You can see we're kind of resilient here in the pre-market, and then we sort of just dumped on the back of this news. Another massive market mover today was United Health, down another 5% after being down 22% in the last trading session. United Health was falling because analysts were revising its price targets down in a very significant way after reporting a double miss and lowering guidance on the back of higher than expected customer utilization and Medicare costs that the company had to deal with. Very, very ugly price action. I said that this stock is probably going to 400, and I do stand by that, down another $25. And Tesla was down 6.79% today. It led the market lower. And this is very interesting because it's releasing releasing its earnings tomorrow after the close. So we're going to see how this stock reacts at the 224 mark just before tomorrow's video. And for everything we saw here today, guys, there were only 1,500 advances, 4,600 decliners, but a lot of them being in this section right here. We actually did see inflows in the NASDAQ and the New York Stock Exchange. However, this was a gap down from the previous closing session. So net, we actually did see outflows, but on the day, there were certainly inflows as the market did move lower. And that is a little bit of a contrarian signal to a degree, but the aggregate number, the nominal number, was for net outflows compared to the previous day. And then market momentum continues to gyrate. We were looking pretty good last week. We fell below the 50% mark here in the 5-day moving average, and we just saw deterioration across all of the moving averages across the board. In other words, momentum lost a step. Diving into the charts, you can see we had a very ugly day in the market. All of the major gauges fell in excess of 2%. We're not looking too good here in the after hours, with value outperforming growth, but both down on an absolute level. You can see even futures not looking too good. Volatility ticked up, and we're still in this backwardation phase right here with near-term volatility more than front-month volatility, and that's telling you everything you need to know. And yields rose again today ever so slightly, longer dated yields especially, but the 2-year yield fell, the dollar also fell, and the very interesting dynamic, we're seeing yields rise and the dollar fall, and that's further increasing the cost of importing a product to the US on top of the tariffs we already have. So if this dynamic continues, we probably are definitely going to see price hikes. And I mean, if you look at a company like Hermes, they're a luxury brand. Last week, they said their annual price increase of 6 to 7% will be on top of the 10% tariff price hikes that they will put on their products. Now, their customers are less price sensitive, but there is a lot of companies that do have the pricing power to increase 15, 16, 17%. That could be detrimental. So the cost of goods are definitely going to go up. And with the weaker dollar, with bonds doing what they're doing, you could even see an exacerbated effect on that. Gold, Bitcoin were both up today, about 2.5%, 2.94% respectively. Silver gained ever so slightly, WTI. And the S&P 500 did not act well today. Now, last week, we said we were looking for some weakness about midweek, and we said into this long weekend, you want to actually de-risk because we don't know what's going to happen on Monday. And on Monday, what you really want to do is wait for a signal as to what's going to happen next. And it looks like we are probably going to go lower. You can see we put in a high right here, lower high, and now a lower high with this recovery. We couldn't go ahead and hit key levels in the S&P 500. And I think what's going to go happen next is we're going to go get some price discovery at these lows right here. The market is going to go retest these lows just to see what happens next. If we get a close below the 4,800 level, I think we're going to see 4,200. However, if we can actually hold, the 5,000 level or this 4,955 level right here, then I do think this is officially the lows in for the year. And then you want to buy this dip with everything you have, because then we probably do go and hit those all-time highs. So it really, really depends. We just want to see what the price discovery looks like at this level and go from there. Now, all of this can change with a single Donald Trump tweet. Ultimately, that is your parameter. If he comes out and says we have a trade deal with China, which is looking less likely by the day, but if something like that comes out, stocks are going to rip higher. But I think in the year and now, ultimately, we probably are going to go ahead and have some price discovery here at these lower levels. The same is true for the NASDAQ 100. And ultimately, when we get here, you want to look for buy signals. I think a strong buy signal would be the reaction of some of these magnificent 7 names after their earnings reports. If their earnings reports are not that great, if their guidance is terrible, or if they pull guidance and the stock acts well the next day or the next week after that, that is a very, very strong signal to probably get long in a very, very big way. And some of the big tech names that I do like, firstly, is Meta. I own this company myself. I really do like Meta. And if they release earnings, it's not this week, it's the week after next. But if they drop earnings and they act well, we can see all-time highs very, very quickly. Another name that I do like that's been incredibly resilient is Visa. Visa year to date is roundabout flat. It's acted very, very well. And so, if you are looking at some of these mega cap names, these are the 2 names that I would look at to add to your portfolio. Now, looking at Bitcoin, let's just see where we are in the cycle. Bitcoin acted very, very well today. It was up 2.43% at the $87,000 mark. And you guys know how we track Bitcoin. We actually look at global M2 money supply, which has been rising in a very significant way. We actually offset it here by 108 days. And if we go ahead and change Bitcoin to a line graph, you can see that we've tracked M2 money supply very, very closely. And when you lag it by 108 days, you sort of get this leading indicator, and it does does look like Bitcoin is ready to blast off, breaking its all-time highs. And you can see it looks like the market is somewhat front-running this move. I do know there's a big Twitter presence that follow this indicator on Twitter, and it does look like we are front-running some of that move. If you do want to get exposure to this, you could probably sell some puts in a ticker IBIT, or you could just, get some long Bitcoin exposure in a ticker like IBIT, or buy Bitcoin itself if your broker allows it on Robinhood or Webull or wherever. But yeah, selling some puts right here in the money puts and collect some premium. And if you're looking for a more leverage play on Bitcoin, you could look at something like BitX to get exposure to this, or even MicroStrategy itself. That being said, I would also put stops somewhere around the 76,000 area, maybe low 70s, 74, 72, somewhere around here, tight stops. And this risk to reward looks really, really good, because if we take a measured move, you're looking at about 50% upside, right? Whereas if we actually look at potential downside, let's say you put your stops at the 74,000 mark, you're looking at potentially, 3-to-1, 4-to-1 upside with this trade. And that is very, very attractive, all things considered. So I do like Bitcoin, and I like Bitcoin more so than gold, but you can't deny the fact that gold is absolutely ripping. This almost looks like a gamma squeeze, and we probably are going to go ahead and hit 3,500, but I'm not stepping into this right now. I think Bitcoin is the far superior play, especially considering what we do know with M2 money supply. And I would also probably be looking at like certain equities. And if I was to get into a commodity, I'd probably look at silver more than anything, more than gold at the moment right now. Let's quickly look at the 10-year yield, what's happening right here. Now, so we clearly put in a high right here, then a lower high, and then a lower high again. And it looks like we are going to go ahead and retest this high. But if we can actually put a lower high relative to this, it probably means yields will continue to move lower. I don't really know what's going to happen. There's just a lot of dynamics occurring at the moment, but it does look like we are in a downtrend. But the market, this is a vicious move to the upside. It does look like a higher low as well, as you can see, relative to this low. So there's just a lot of dynamics. And I think what we want to look for is a convincing break of this level or break of that level to determine where we go next. The DXY at the 98 level, this is what we said would happen all year. We were expecting the dollar to decline. We said we'd probably get to the 100 area. We've broken it below that. And how low can the dollar go? I'm not really sure. If we actually just get the monthly chart and we zoom out, I mean, this looks like a blip on the radar, all things considered. But ultimately, it does look like the next level of support on the monthly chart is the $90 area. And that would be absolutely brutal. When was the last time we got it? 2021. So, I mean, on the monthly chart, you're probably looking at the 90 level, because this was strong support. We've broken through that. It does look like we'll probably go lower from there, but that's technical analysis on the dollar. I don't really think you can really do that, all things considered. But for all intents and purposes, guys, I think what you really want to do is wait for price discovery at these levels right here in the S&P 500. And if stocks act well, if we get the right buy signals, which I will keep you up to date on, that would be our signal to buy. Otherwise, we could actually see, targets to as low as 4,200 in the S&P 500. So let's stay patient and let the market do its thing.
And diving into sentiment, this is CNN's Fear and Greed Index. And guys, we are still in extreme fear. However, that deep pessimism we saw when we were here at the lows in the single digits has abated. We have seen the market respond positively to some of the market developments we have seen and heard from the administration. However, we are still in extreme fear, close to the fear zone. Don't get me wrong, but we are still in the extreme fear zone. And obviously that is going to keep market participants on edge. And we have seen market participants react accordingly. Commodities, inflation hedges, gold and silver, safe havens, and government treasuries were some of the most bought assets last week versus equities versus every other type of debt or commodity. But all of this is backward-looking data, and it kind of just confirms what we already know, that the market is still on edge. We need to look at forward-looking data to determine what comes next, and that is seasonality. Now, this is the May to December return of the S&P 500 in 3 different scenarios in April. When April is negative, when April is greater than 3%, or when we return in between 0 to 3% in the month of April. Now, right now, the S&P 500 has returned negative 5.86% for the month of April. That can turn any point in the next week. However, in the year and now, it does look like we are going to have a negative April. And for the period May to December, that means we can expect an average return of about 0.29%, 12 up years, 10 down years. Things don't look too good when you compare to April being positive, where we normally see returns of 5.4% and 9.23% respectively. So what is this telling us? Expect more volatility ahead, especially if we get a negative April. And earnings is somewhat confirming the same thing. This is S&P 500 12-month earnings around 10% S&P 500 corrections. And normally when we have a recession within 12 months, earnings don't do that well. And forward EPS estimates are starting to track the recessionary path, this right here. And you could see that we are moving down. This isn't a good look for earnings. And now it's up to us to determine from this earnings season whether we are going to get something like this, right? And sort of bounce here and then move up, or if we are going to continue on the recession path, and that's not going to look good for equities. However, you don't ever want to wait for EPS to bottom to buy the dip, because the S&P 500 is forward looking. The S&P 500 on average bottoms about 9 months before earnings bottom. So you want to be buying the dip retroactively, because by the time earnings trough, right, the market is already 20, 30, 40% higher looking at the next 12 months. And diving into the macro, CEOs are not that confident. A majority of US CEOs now see a recession, a mild slowdown, or a severe recession on the horizon. This is not good, and they're probably looking at their data, looking at tariffs, looking at how they're going to navigate 2025, and they're not too optimistic. Furthermore, analysts are not optimistic. Consensus 2025 GDP projections have been revised down significantly from 2.3 to 1.7%, and it does look like we probably will go lower if this trade war continues. And also the labor market, looking at federal employment tax receipts, not looking too good at the moment. We are clearly in a slowdown, because we actually peaked right here in January, right, at 11.3% year-over-year growth. And then we've slowly decelerated to 6.7%, to 5.3%. And now for the month of April, we're looking at 1.2% growth. And if you actually include the last week of March in this April figure, you're looking at probably negative growth in this period right here. So the labor market is slowing. Income, employment could be rolling over, and this all has to do with tariffs. We've had a lot of layoff announcements, and ultimately Donald Trump's policies are impacting the economy. We're going to keep a tight eye on this. It could be seasonal weakness. We normally do see seasonal weakness this time of year. However, we're going to be retroactive in looking at the labor market, because if this turns, we're going to have to adjust our portfolios accordingly. And the way we keep up to date with this is simply by looking at the economic data. And this week, we have a slew of data, mostly after Wednesday. But tomorrow, Tuesday, we have a number of Fed speakers, Kashkari, Kluger, etc. They're all speaking. Nothing major with economic data, but then we do get the PMIs here on Wednesday. Earnings is what's really going to drive the market, I think, this week. Tomorrow, the big names is Tesla, Intuitive Surgical, Enphase, but we also have SAP, Capital One, Baker Hughes, and that's all after the close. Before the open, we have Verizon, GE, Lockheed Martin, RTX, all of these defensive names, Halliburton as well, Elevance Health, Danaher. So they're all reporting before the open, and we do have a couple of other big names here, Wednesday, Thursday, Friday after the close. And what is a big month for earnings as a whole. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.